Hello, everyone, and welcome to your Daily 5 for Wednesday, the 31st of May. My name is Julius de Kempenaer, and I'm hosting today's show from Amsterdam in the Netherlands. Let's get straight to the charts. Starting with a look at the relative rotation graph for the sectors. And I already told you in the intro what my focus is for today. And we can see that better on the image right here. It's about the utility sector, which is highlighted here, and you can see how that is rotating from improving back into the lagging quadrant without hitting leading. And a similar rotation is playing out for the consumer staples sector. They went through improving and they're now back into lagging, or just crossing back into lagging. And we know that that is a characteristic of a very weak relative rotation. On the other side of the graph, we obviously have technology and communication services way to the right, but as you can see, they're losing a little bit of momentum. Doesn't mean they're weak, but they're kind of going through a little break. What's more interesting is what's happening in the consumer discretionary sector. And as you can see, that came through improving. It sort of crawled into leading and is now starting to move right, which means that it's picking up relative strength on the JDK RS ratio scale. Makes it an interesting sector to see if we can find some interesting stocks in that sector. Now, if we start with the utility sector, then these are the names that are inside the utility sector, and you can see the rotations against the utility sector index, XLU. And we can't go over all of these charts, obviously, here in the show because it's only 10 minutes. But what I'm looking at here, the one that I really want to look at is ES, which is like coming out of this cluster and starting to move into further into that lagging quadrant. Eversource energy, and you can see the rotation right here. And if we play that back, you can see how that just shaved off that 100 level and then started to move back into that lagging quadrant and now really on that negative heading. If we bring in the individual price chart for Eversource, then we can see what's happening. This chart, look at the relative strength here. That has been in a massive downtrend and a massive declining trend from the start of 2020 onwards. And what's happening right now, that very recently we broke a major low that was set back in 2018. And what's more important, because relative strength is all cool and all nice, but it's price that is most important. And what we see here in the price chart is that ES is about to break or is breaking downward out of a massive trading range that has been in place since 2020. There is only a little bit of support left here around 67, and you can see how I've shaded that line. It's very light, meaning that it's very light support. These are the more important levels. You can see a support range here at the bottom and a resistance range at the top. And it looks very clear that we're coming out of that range on the downside, supported by weak relative strength. So ES is definitely a candidate to either avoid or play to the downside. Now, the second sector is consumer staples that we looked at, and that was also a sector that is rolling over to the downside. It's moving back into that lagging quadrant. And when we look at the individual stocks, as it is right here on the RRG, compared to the consumer staples index, and again, we can't go over all of these names, but the two that really stand out to me, the first one is that's very easy. That's EL, Estee Lauder. Let me highlight that. It's right here. So you can see how that is at a very long tail moving further into the lagging quadrant. And the second one, which may not be as clear, but when we look at the chart in a minute, you'll know why, is WBA, Walgreens Boots Alliance. So these two are the ones that I want to highlight inside the consumer staples sector, and also as either a warning signal or a potential play to the downside. Let's look at EL here. Look at that price chart. It's resting at a massive support level. This is a really important support level. We had two of these tops here around 280, 282, which were tested back in 2021 as well. And now the last rally didn't even manage to get back to that 280 level. We peaked around 260. We break that low, so we've got lower highs and lower lows in place. And we're now about to break the October 2022 low. And you can see that when that happens, pretty much opens up the downside all the way down to 135, 130. If you look at the height of the range here, it's probably 190 to 170. That's even about $80 to the downside. That would suggest that even 100 is potentially on the cards. Anyway, whatever the number is, whatever the target is, it's a massive downside risk. The trigger probably when we break below 190, 185. The relative strength line is definitely taking going ahead of that move, breaking below very important horizontal support on the raw RS line. If we go to the second one, that is Walgreens, WBA, and look at this chart here. It's resting at support. Raw RS is rolling over, is going down, and the only reason why you can see that pickup in relative momentum is because of the hesitation that we had right here, and we're hesitating just above that support level. Now, this is a great example of a chart where you shouldn't confuse the bottom of the chart with support, because if I make this a monthly chart, look at what happens. You can see here that there is way more downside available in WBA when that level around 30, where we currently are, when that breaks, there is way more downside, and relative strength is at its lowest level ever. And the only reason why it's cut off is because XLP, the benchmark, didn't exist before 1998. Nevertheless, WBA definitely a stock to be careful with. And then finally, we go to the more positive side, and we're looking at consumer discretionary. And consumer discretionary here, I've got all the individual stocks. And if I do that against RCD, that's the consumer discretionary index equal weight, we got a little bit more of a spread here. And then there are two names that I want to pick out. And the one to start with is Amazon, just because it's such a massive stock, but also because it's got a really nice price chart that is developing really nicely. And then the second one, and I had to choose between RCL and CCL, both cruise lines. And I went with CCL because I do think that there is more upside potential in CCL than there is in RCL. And you can see that on the RRG as well. RCL is already way to the right, meaning that it's already done a lot of moves, and CCL is just pushing into that leading quadrant. If you look at the price chart for Amazon, then we can see that it's coming out. It tested a massive support level, coming out of it, just breaking above its previous highs, signaling that the rhythm of higher highs and higher lows is definitely intact, and a nice break out of that falling trend channel. So Amazon, watch it through buyer's eyes. And the same goes for CCL, Carnival Cruiselines. You can see how that tested support. Relative strength is picking up, and it's upside potential there, especially when it can take out $12.50 to $13 to the upside. And that wraps up the show for today. Thank you for watching. I'm looking forward to seeing you again at a new episode of Your Daily 5 here on StockCharts Television.